All right, folks, welcome to the road to tax-free wealth, Roth Conversions in 2018 and beyond. This is H. Quincy Long, CEO of Quest Trust Company, and this is one of my favorite talks. But before we get started, Quest Trust Company does not provide tax, legal, investment, or structuring advice, nor do we endorse any products, services, or investments of any type. All information materials are presented for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of transaction or investment, and that includes, of course, Roth Conversions. All right, just as a basic understanding, what is a self-directed IRA? It is nothing more than an IRA in which the IRA owner directs all investments in the account. There's no legal distinction between a quote-unquote self-directed IRA and any other IRA, except that with a truly self-directed IRA, the account agreement allows the broadest possible spectrum of investments. We're going to talk about that a bit later in the presentation. So what types of plans in general can be self-directed? It's not just the Roth IRA, which we're going to talk about today, but it's also the traditional IRA, where old 401k or employer plans go to die, by the way, so that's good information. We also can self-direct the SEP IRA, the simple IRA, and have an individual 401k program, which includes a Roth 401k element for those who have self-employment income but have no employees. Then there's the Would You Like Fries with That accounts of the Coverdell Education Savings Account and the Health Savings Account, both of which are incredibly good, but especially the Health Savings Accounts, because that's the only account you can put money in, get a tax deduction, and yet you can draw it out tax-free for qualified medical expenses. Before we get into the actual topic, I'd like to present what I like to call the effect of taxes. So if you had $100,000 in an account or in three different types of accounts, and assume you were in the 35% bracket and could stay there, and you could get a 10% return on all your investment, and then you withdraw it at the end of 30 years, how would that work, or how would that look? If you just had those funds in a normal outside of retirement account, you would have at the end of the period $661,436.62, which really isn't a bad result for starting with $100,000. But your tax loss would equal over $1,083,503. And what I mean by tax loss, well, what I mean is not only the taxes you had to pay, in this case 35 cents for every dollar you made during the 30-year period, because it was not within a retirement account, but also the lost opportunity cost, because if you think about it, instead of having $1 to invest in profit, you only had 65 cents to invest in profit. So over time that really accumulates to a lot of loss. So the tax loss, including taxes paid and opportunities lost, is over $1,083,503. Now, if you had that same amount in a traditional IRA, you would accumulate a total of $1,744,940.23. But of course, when you withdrew it, you'd have to pay 35% of that, or $610,729.08, leaving you with $1,134,211.15. And again, that's a much better result than $661,436.62. But the tax cost in this case is not the opportunity lost, but just the taxes you paid. And so that would be a $610,729.08 loss. Now in the Roth IRA, you accumulate the same amount, $1,744,940.23, but all of the money in a Roth IRA belongs to you. None of it belongs to the government, assuming it's a qualified distribution. So in that case, you have no tax loss whatsoever, no opportunity loss whatsoever, and all that money is yours. In a traditional IRA, part of the money belongs to the U.S., part of it belongs to you, but not in a Roth IRA. It's all your money. So I'd like to kind of put that out there as a demonstration of why we like Roth IRAs so much. Now, it's been said by many people that loafing is the only way to beat the income tax. And I think that could beat the income tax for some people, but I like to have a Roth IRA, and I think that's the better way, is to have a Roth IRA. You can beat the income tax with a Roth IRA and still live a great life. So let's take a look at this. Just the basic contribution rules. $5,500 contribution in 2018, it goes up to $6,000 in 2019. $1,000 catch up if you reach age 50 or over by the end of the year, so that would be $6,500 for 2018 and $7,000 for 2019 if you reach age 50 or over by the end of the year. But it's subject to income limitations. So there you can see the income limitations. If you make over $135,000 in 2018 or $137,000 in 2019, you are simply not eligible to directly contribute to a Roth IRA. And for married persons, that's if you make over $203,000 in 2019. Married filing separately is a tax status that they punish in a lot of ways. So if you make over $10,000 and are married filing separately, you cannot directly contribute to a Roth IRA. The contribution rules did not change, however, in 2010, but the conversion rules did, and that's what we're going to go over next. Some basic Roth IRA facts that I like to throw out there just to set the scene. The prior year contribution can be funded until your tax filing deadline for that year without extensions. That means as we record this session today in January of 2019, you still have time to make a contribution all the way up till April 15th or whatever the tax deadline is for this year, but no extensions. That means that even if you extend your tax return, you cannot make a Roth IRA contribution with a regular contribution after the regular tax filing deadline. So that's important to know that. Also interesting is that if you have a spouse that doesn't have compensation type income, but you're married and filing jointly, and one spouse has enough to cover both spouses' contribution. In other words, if you have a spouse making $15,000, then $7,000, and they're both over age 50, of course, then $7,000 can go into an account for each person, even if one spouse doesn't work. So that's a good thing to know as well. And of course, what we're all after is those qualified distributions, which are tax-free forever. We are going to go over what that means in a minute. There are no required minimum distributions for the original account owner from a Roth IRA as opposed to from a traditional IRA. And perhaps more important than even all of that is that you can create tax-free income for your heirs for their entire life after you pass. So those are some great benefits of the Roth IRA. Now, we talked about the situation that you have to have a qualified distribution, and that would be one that was tax and penalty free. But to have that qualified distribution, it has to meet two requirements. The first requirement is that it has to be made after the 5-year period beginning with the first taxable year for which a contribution was made to a Roth IRA set up for your benefit. So, for example, if you make a contribution before tax filing deadline for 2019 for the 2018 tax year, the first date you're eligible to take a qualified distribution is January 1st, 2023. In other words, the 5 years is January 2018, 19, 20, 21, and 22. Now you've completed your 5 years, and your first eligible day to take a qualified distributions, assuming you meet the other tests, is January 1st, 2023. Actually, it's January 2nd, 2023, because we won't be open on the 1st. So, anyway, so what's the second requirement? To meet the second requirement, you have four choices rather. One, the distribution can be made on or after the date you reach age 59 and a half. Two, if you become totally and permanently disabled under the definition of the Internal Revenue Code. 3 to your heirs or your beneficiaries after you're dead. It kind of sucks for you, but or maybe it doesn't. And but it's great for your heirs. Or you can take up to a $10,000 draw for a first-time home buyer for you or any of your dependents. So those are kind of some of the ways you get a qualified distribution. Now, by the way, just to be clear about this, you can also withdraw your contributions, your regular contributions, not your conversion contributions, but your regular contributions can be withdrawn at any time, tax and penalty free. So there's more than one way to get money out of your Roth, tax and penalty free, but qualified distributions have to meet both of these requirements. Now, after hearing all that, I'm sure you're like this kid. You're like, I make too much money for a Roth. But there are worse things to have than to not qualify for a Roth because you make too much money, like qualifying for a Roth because you don't make too much money. Personally, I'd rather make too much money to directly contribute to a Roth and then use the alternative to get money in the Roth anyway, which is Roth Conversions, and that's what we're going to talk about next. So speaking out about the benefits of leaving money to your heirs or your beneficiaries in a Roth IRA, suppose you had $100,000 to leave in a Roth IRA and you left it to a young beneficiary, say a grandchild or a great-grandchild, who inherited it at age 6. That means your grandchild or great-grandchild would have to start taking distributions at age 7, the year after you passed away. And what would that be worth to that kid in lifetime distributions, assuming the kid took only the minimum distribution necessary every time? Well, if you could get a return of 6%, statutory, the uniform lifetime tables indicate that the kid will live for 75.8 years, so the account must be distributed within that time. But if you can get 6% yield, the kid will draw a total of $2,033,743. I mean, that's pretty good. That ought to get your picture on the mantelpiece for grandpa or great-grandpa leaving you money. If you could boost that to 12%, it would be $80,496,367 tax-free dollars over that kid's lifetime. That'll get more than a picture on the mantelpiece. That's probably a wall painting at least. If you could get 18% consistently, it would result in over $3,420,454,810 tax-free dollars. Now, of course, what is the real point of this slide? One point is it's not going to be possible. The more money you get, the harder it is to get those yields. Although at lower numbers, you can get yields much higher than that. But obviously, that's unrealistic for the numbers. But here's the point. Two things to realize. One, if you're not paying taxes, you can accumulate wealth a whole lot faster. And the second thing is yield matters a great deal with how fast you accumulate money when you're not paying taxes. So yield and taxes, that's what we wanted to make a point here. So who wants an inherited IRA right now? I hope all of you are raising your hands. Okay, some Roth conversion rules now. Traditional IRAs, including SEP IRAs, by the way, which is an employer plan, but it's like a traditional IRA with special contribution rules, can be converted to a Roth, as well as simple IRAs that are more than 2 years old. And any former employer plan, like a 401k or 457 plan of the government or the 403b plans, all of those can be converted to a Roth IRA. The restrictions that we used to have of converting with modified adjusted gross income, that's MAGI there, of more than $100,000 and on married person filing separately are gone. So now even married person filing separately or people making more than $100,000 a year can convert to a Roth IRA. The conversion amount, of course, is added to your taxable income in the year of conversion. We'll see an example of that in a minute. And now they have a special feature. If your plan allows it, you can actually do a Roth conversion within your 401k plan as long as the plan allows for that option. So those are some of the basics of Roth conversions. So let's go over an actual case study of how this might work in a real life scenario. Suppose we have our friend Realtor Rose and she decides to convert her traditional IRA, which has a balance of $50,000, all in before tax contributions and gains. How's that going to work for her? That means that Rose's net taxable income is increased by $50,000. And if she's in the 28% marginal tax bracket, that means Rose's income tax bill is increased by $14,000, or $50,000 times 28%, over what she would have paid had she not converted, assuming, of course, she remained in the same tax bracket. Now, let's think about that. Why would anybody voluntarily pay $14,000 in extra taxes to get a Roth IRA with $50,000 into it? Well, let's take a look. Some things to consider when you're thinking about whether to do this or not. One, what are your assumptions about tax rates and tax laws generally in the future? Are they going to become more favorable? Are we going to get that infamous flat tax that everybody always talks about every 4 years? Whatever your theory is, if you think tax rates might be going up, then it might be a better time to convert now, whereas if you think they're going down, you might want to wait and see what happens later. But you got to pay the tax man unless the money's in a Roth IRA or another tax-free account. Do you expect to be in a lower or higher tax bracket when you retire? For example, I'm recording this in Texas. We have no income tax in the state of Texas. What if I retired in California or someplace where they have a much higher tax situation? I may be in a lower tax bracket and yet an entire higher tax situation when I retire, just depending on where I retire or what I'm doing. Can you afford to pay taxes from outside of the funds in your IRA? Statistically, it can be proven that if you just took the money out, did the Roth conversion and took the money out of the IRA to pay the taxes and invested the balance, you would end up in a similar situation than if you just left the money in the traditional and invested it. So that's not favorable to you, although it does make some dubious assumptions. What is favorable to you and can be demonstratively favorable to you by spreadsheet is if you can afford to pay the taxes from funds outside of your IRA, your money grows a great deal faster and your overall wealth situation increases significantly over time if you can just afford to pay those taxes from your conversion with funds outside of your IRA. Another question, will the conversion put you into a higher marginal tax bracket, or will it affect deductions, credits, Social Security, Medicare due to an increase in your adjusted gross income? Any adjusted gross income increase has an effect on your taxes that you owe, and sometimes on deductions and whether Social Security is taxable and all of that. So it's more complicated than just what are the extra taxes you're paying, is what is the effect on your whole tax bill. The other question is, do you want to leave the payment of taxes to your beneficiaries, or are you willing to pay the taxes now so your beneficiaries receive tax-free income for their lifetimes? Now this is a very interesting question, because some of you are probably thinking, well, why in the hell would I pay taxes so that my heirs can have, or my beneficiaries can have, tax-free income to their lives? Isn't that their responsibility? Well, that's one way of looking at it. Or another way of looking at it is like the doctor that I talked to one time who asked me, can I convert my $6 million traditional IRA into a Roth? And I was kind of taken aback, and I said, well, sure, but that's going to, leave you with an awful big tax bill. And he said, that's okay. He said, I have terminal brain cancer, and I'd rather leave my kids with $4 million in Roth money than $6 million in traditional IRA money, especially considering the fact that that will reduce the size of my estate and my estate taxes So he was using this as an estate planning technique. So it's very interesting. And some people like me just think the value of the Roth is so high that I'd rather pay taxes now than what I hope is a bigger balance later. But the final question that you really need to ask you, and I think this question almost trumps everything else, is what are your projected gains on your investments? I mean, if you make a fantastic gain on your investments, I don't care if you're a 105-year-old, it's still a good deal. So we'll look at some examples of that in a minute. So how do you analyze a Roth conversion for yourself? Because nobody can stand up in the front of the room or on an audio and say you should do a Roth conversion, because it's highly dependent on your individual tax situation. And so a person would have to know your entire income and your plans for the future and all kinds of things to help you decide whether you should do a conversion. But I've given you some things to think about. And anyway, you do your best to calculate the cost of your conversion, the extra taxes you pay on the conversion income, whether again that's the taxes you actually pay or the effect on other types of taxes that are in your income tax situation. Then you recalculate your recovery period. Now this is probably something that I look at a little different than a lot of people do, a lot of advisors do. I say you calculate your recovery period, and that to me is how long will it take you to get back the money that you had to pay in extra taxes. In other words, how long is it going to take your Roth IRA to grow more than the taxes cost you that you paid extra for doing the conversion. And then you also have to factor in any lost opportunities to live on that money that you use to pay taxes and or invest the money you use to pay taxes, like in real estate outside of the retirement account. So that's a tough thing to do, but if you can estimate that, then the next step is to decide whether the cost of paying the extra taxes now is worth the tax-free growth potential of the Roth based on your investment assumptions and opportunities lost by using some of your money to pay taxes now. It seems so easy when I read it, but the truth of the matter is it's a complicated analysis that only you can make for yourself. All right, when I said how to analyze it, here's going to be the example of how to look at a Roth conversion, or the way I look at it. So in our friend Rose's case, she converted $50,000 and it cost her an extra $14,000. So if she can get 6% return on her investment, that's the ROI, then it'll take her a little over 4 years to recover that money. And then by that I mean that her Roth will grow from $50,000 to $64,000 in 50 months. And after 10 years, if she keeps up the 6% yield, would be worth $90,970. Now, if you could double that and you could get the yield up to 12%, that would only take you a little over 2 years to recover your money into the Roth IRA, and that Roth IRA ended up at 165,019. If you could do 18%, that would only take you 17 months, and you'd end up with 298,466 after 10 years at a steady growth at 18%. So once again, we see that yield matters a lot in how fast you can accumulate wealth. And again, just the raw numbers doesn't take into account what else you might have spent the money on, including Starbucks or investment property outside of your retirement account. So what can you buy with a Roth IRA? Well, you can buy all kinds of stuff, of course, including all types of real estate, private entities like limited partnerships and LLCs, promissory notes, where you lend your IRA money out at rates that you and the borrower decide, foreclosures, commercial property, all kinds of real estate options, tax liens, LLCs, joint ventures, trusts, notes that are secured or unsecured, mortgages, convertible notes, shared appreciation notes, net profit notes. There's various ways you can invest your money. So it's one of the benefits of having a self-directed Roth IRA is instead of just, well, frankly, gambling in the stock market, you can actually do what you're most familiar with, assuming you're familiar with something other than stocks, bonds, or mutual funds. You can use your retirement money to invest in that way. So let's take a look at some examples. Now this is an actual example, sort of. This was my mom's account, my mom's traditional IRA on 9/25/2006, and she wasn't very happy with her advisor and what he was getting in her IRA. And her IRA was worth $64,960.09, and she turned it into a self-directed IRA and said, "Son, I think you're a pretty good investor. Why don't you help me out?" Well, if she had done a Roth conversion, which she didn't do, I told her she should, but she didn't do that, she would have had to pay, assuming she was in the 28% bracket, $18,188.82. And of course, when I'm assuming that, I have to assume some tax bracket. That's a very common tax bracket, but obviously your tax bracket affects the cost of the conversion. But if she had done that, she would have paid $18,188.82 in taxes at 28%. And 3 years later, it was worth over $90,259, which is a dollar gain of $25,299.14 and a percentage gain of 38.95%. Now let's look at this real carefully. Now in 3 years, my mom gained over $25,000 in her account. That means her wealth overall increased by $25,000. And how much did it cost her to do that? $18,000. So in a matter of a little over 2 years, 2.5 years, she would have more than made up the entire amount that she spent on taxes, and everything for the rest of her life and the rest of my brothers and I lives when she left them to us would be all tax-free forever. And so you might wonder, how in the world did I get such a great return in only 3 years? Well, it did nothing more than hard money lending, loaning money out at rates of 12 to 15% interest, and was able to accumulate a 38.95% yield. So that's really something to think about. Now, I like this example too, because this is actually an example of somebody, one of our clients, who was able to do a Roth conversion when the property wasn't worth as much, and yet made a big profit after he had converted it. So in this case, he bought a 10-acre parcel at a tax foreclosure sale on 10/6/2004 for $16,000 out of his IRA. Then the conversion, and again, I don't know his individual tax situation, but just an average person, his tax, if it was at 28%, would have been $4,480. Now, the thing about tax foreclosures in Texas, and again, this is not true in every state, but in Texas, the title to a tax foreclosure property that you get at the tax sale is got some encumbrances on it for 2 years, or up to 2 years, depending on which type of property it is. In this case, it was just raw land, so with no agricultural exemption. So this was actually a 1-year limitations period, after which the title could be insured by a title company. So what am I saying? Basically, what I'm saying is that he bought it at $16,000 with a defective title, and I say that with my hands making quotation marks because it wasn't really defective. It just had some encumbrances on it, which were going to go away in a short period of time. And so once he waited the period out, then he spent another $8,000 doing a subdivision, where he subdivided the 10 acres into 5 2-acre parcels, and then he sold those 5 2-acre parcels for a profit of about $75,032, or 314% over what he had into the deal of $23,891. Now again, I think that's better than 12% or even 18%, and he increased his account significantly. So again, this is something that he could have a pretty good idea that they were going to go up in value substantially and by converting either the cash to do the deal or the deal right when you buy it, then you are able to put that profit in your Roth IRA. Another example is a pilot, a retired pilot, that saw a deal that he thought he could make some money on, and so he converted $12,000 on 2/28 of 2005. This was before the new rules that allowed anybody to convert. So the max tax he could have paid, due to the fact that at $100,000 the max tax rate was 28% at the time, the max he could have paid, and he could have paid less, was $3,360 in taxes to convert $12,000. And so he then found a mobile home that he could purchase. It was a distressed mobile home he could purchase for a little under $12,000. So he did. He converted $12,000, and then he purchased this unit on 2/28 of 2005 for $11,613.22, and then he sold it 6 weeks later to the neighbor for a net to the IRA of $25,134, and a $5,000 note that paid off 3 months later for a total profit of $18,520.78. And so how many of you listening to this would pay $3,360 out of your personal pocket to have $18,520.78 show up in a short period of time in your Roth IRA? I think everybody would have to say yes to that one. So these are just some examples of things you can do. Now, what if you make a mistake and convert and you can't really afford to pay the taxes? Well, starting in 2018, it's too bad. You're unable to do a recharacterization, or in tax terms, or in common parlance rather, an unconversion or reconversion back to the traditional IRA. In other words, once you convert, you're stuck with it. You can't go backwards. All you can do is pay the taxes. So that means you have to have a plan to do something with the money that you do a conversion with. So my standard education for everybody is always start the Roth conversion and get the 5-year clock going, but don't convert excessive amounts of money until you have a deal to back it up. In other words, I had a doctor one time that converted over $800,000, and he later decided he couldn't afford it, and he was able to put most of it back into his traditional IRA. I said, like, why'd you do that? He said, well, I thought it was a good idea. So it's only a good idea if you have a plan. In other words, if you have something you want to invest in, it's quite easy to do a Roth conversion at Quest Trust Company. It's just a matter of paperwork in a day or two, and you can move the money into a Roth and have the Roth make the investment. But there's no reason to pay taxes before you have to, unless you have a reason you think something's going to change, like the tax rate or your tax situation. So just think about that. Have a plan to invest your money when you do a Roth conversion. So can you do a partial conversion? Answer is yes. You can convert as many times as you want in a year, and you can do any part of your traditional IRA or other account into the Roth IRA. Can you convert assets or only cash? Nope, you can convert assets just fine. Yes, you can convert assets just fine, as well as cash. The difference is it's a little more difficult to establish a fair market value on a non-traditional asset such as real estate or a note, because if you think about it, in the stock market, if you're converting stocks, you just look at the price at the end of the day. But with real estate or a note, you have to have some kind of appraisal to verify the value, since it's a taxable event. So the ultimate deal here is, do you want to pay taxes on the acorn, which I call your traditional IRA balance now, or the mighty oak tree, your traditional IRA balance when you pull it out, either a little bit at a time or in a bulk after years and years of accumulation? If you're a decent investor, that's a question that's easy to answer. So ultimately, the goal of Roth Conversions is a tax-free pile of gold at retirement that you can use for yourself and leave to your heirs. I hope you've enjoyed this presentation. There's the contact information for me. Give us a call or go to our website and get some more information on Roth Conversions, and call an IRA specialist at 855-FUN-IRAs. Thank you for your attention and have a great day.